From New York City for our viewers worldwide, I'm Matt Miller, in for my friend Jonathan Ferro. We're looking at actual movement in the markets ahead of a Fed decision. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, Chair Powell in focus with the Fed rate decision on deck. Treasury yields pulling back from the highest levels they've hit since 2007 as markets face mounting headwinds out of Washington, D.C. We begin with the big issue, gearing up for a hawkish pause.
The Fed will do what we all expect it to do.
So they'll pause.
Pause.
Hawkish pause.
A hawkish pause.
A pause, but an indication that they're prepared to do more.
They'll keep wide open the possibility of another hike.
Leaves the door open for a November hike.
I don't think they can say they are done.
They're going to remain vigilant.
They'll make it very, very clear that they are still data dependent.
And they're going to push back against this notion that they'll be cutting anytime soon.
The big question mark is, are they going to do something in November?
What do they do November 1st? Their next meeting.
I think that the Fed is done hiking rates.
We see inflation coming down.
They're going to raise rates in November.
The economy is still very strong.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
Whether they hike again in November is yet to be seen.
November, we'll see what happens.
Joining us now to discuss is Kathy Jones of Charles Schwab and Troy Gajewski of FS Investments. And, you know, before we get to what's to expect out of the Fed, or maybe that is wrapped into this, let me ask you, what has driven yields so high? Really across the curve, I think except for the 20s and the 30s, we've seen 2007 highs. Let me start with you, Kathy. What's pushed us there?
Yeah, the term premium, that risk premium that you get for locking in yields longer term, that's pushed higher, partly because economic growth in the third quarter has picked up and expectations for the next Fed rate cut have been pushed out into the future. So we've seen real yields really move sharply higher, and that has been the driver here, not inflation expectations, but real yields. I think they're about 2% on the 10-year now. That's the highest they've been since about 2007. So that's really been the big driver behind this push up in yields.
Troy, what do you see when you look at this yield curve and we're awaiting a Fed decision that could really signify the end, even though we're expecting a pause, the end of this rate hike cycle? Is it time to buy?
Yeah, we think you want to be still very cautious on duration. To Kathy's point, you know, so much of it's been driven by the recent stronger economic growth and obviously inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels. And then the flip side of that, of course, is, you know, the supply. When you look out, you know, months and quarters and now 5 to 7 years, there's going to be a never-ending supply of treasuries at a time where the Fed is still doing very, very aggressive QT. So whenever you have a yield curve that's still this incredibly inverted, it's very difficult to argue you have great risk reward in duration. And our main message to people when it comes to duration is not that you don't have upside in the next downturn, because clearly in the next economic downturn, at least the 10-year will go to 3 to 3.25 as the Fed cuts to, you know, approximately 3% in the front end. It's just between now and then, you can experience substantial pain, as we've seen recently through bear steepening price action. And with the economy running as hot as it is, that looks as likely as yields have peaked. So it's still a tricky place to be. You know, duration has continued to disappoint investors. And, you know, the great news now is there's so many alternatives that can benefit from higher income for longer, particularly those tied to floating rate exposures.
Troy, can you, qualify how aggressive this QT really is? Because critics have called it quantitative drip here. I mean, we're still at $7.5 trillion, right, in terms of the Fed balance sheet. They've raised rates 525 basis points over the past couple of years. And, you know, we've still got inflation that's double their target with unemployment that's well below 4%. So it doesn't seem like it's been that aggressive, at least in its results.
Well, look, some would argue that last year's outcome for 60-40 was quite painful, especially if you were overweight, growth stocks. And part of that was obviously driven by a transition from a massive balance sheet expansion, unprecedented, to a very aggressive QT program tied to aggressive front-end hikes. So, this is only the second quantitative tightening, so there isn't a lot of history to compare it to. But, the Fed is progressing at 4 to 5 times the pace of balance sheet reduction compared to the 17, 18, 19 experience. So much more muscular. But to your point, when you look at how much the balance sheet expanded, they've only taken 10 to 12% of that off relative to where it was at the peak. And they still have a very long way to go to get that balance sheet around to the 5 to 6 trillion range, which is what they've articulated as their end goal. So when you think about what that means for broader liquidity, remember, there's only two ways to create money, right? Either the banking system lends aggressively, which clearly is not happening. The banking system was already pulling back prior to the bank failures, or the Fed prints it. And so we're in an environment for the foreseeable future where money supply growth, if it grows at all, would be a victory for the Fed. But it's certainly not going to grow faster than nominal GDP. So you're not going to have excess liquidity to drive asset prices higher and higher like you had from most of the 2009 to 2021 period for the economy and markets.
All right. So it's still, it's a really fascinating situation in that case because they've done so much. And certainly in markets, we've seen an effect. But it feels like in the economy, there's still a lot to do. PIMCO's Geraldine Sundstrom weighing in on the November debate, not today's meeting, but November's, says, quote, there's still a fairly elevated chance of another hike before year end. Higher for longer is likely the mantra for U.S. rates as inflation will remain a little bit stickier than expected. Kathy, what do you expect out of today's dots and SEP?
Yeah, I think we're with the consensus. We might see a little bit of a shift in the dots. Last time we had 12 dots indicating another rate hike. That may come down just a little bit, but I don't see that the consensus will shift very much. And then the focus is really going to be on, as we go out into the future, are we going to push out those expectations for rate cuts into 2024? I think that that's a possibility. And then there's a small chance that there's an adjustment in the very long term, the terminal rate. You might see a couple of members shift up that dot a little bit. I don't think that that's a high probability, but it's something people are keeping an eye on. In the SEP, they'll have to revise up the GDP numbers based on third quarter bouncing up. But I don't think for the year there'll be a huge change in the GDP estimates. And keep in mind, it feels like the economy is really buoyant because we've had some good numbers in the third quarter. We've been below 2% real GDP for 4 or 5 quarters on average. So we have slowed the economy down. We are seeing the unemployment rate move up. I think the Fed will have to adjust, near-term unemployment down, but stick with a longer-term unemployment rate rising. So it's going to be a mixed bag, but I really think that we kind of have to push back against this notion that the economy is running on all cylinders. I think it might be running on fewer cylinders, because I know you're a car guy.
Yeah.
Fewer cylinders. They're not all firing at once the way they were, during the immediate post-COVID period when we had all that fiscal stimulus.
Maybe it's battery powered and we just can't find a charger right now. A Fed rate decision, obviously, really the focus all day long. That'll come out at 2 p.m. Eastern. Reminder to our viewers. Of course, it's followed by Chair Powell's news conference that comes 30 minutes later. You can watch Tom, John, and Lisa on A Fed Decides. It's special coverage this afternoon. And, of course, Mike McKee, a very important part of that, Bloomberg's international economics and politics reporter. Joining us now from Washington, D.C., he's got a preview of what we can expect. Mike?
Well, Matt, we're going to play a game here to make the 2 o'clock announcement more interesting because everybody knows the Fed's not going to do anything. First part of the game is the word finder. Take a look at the statement and the part of the statement that has said in determining the extent of additional policy firming that may be appropriate. If that word additional stays in there, they're still thinking about whether they need to raise rates one more time. Second part of the game, count the dots. Kathy brought this up. There were 12 dots predicting a forecast of another rate hike in June. Does that come down today? Do fewer people think that there is still going to be one more rate hike, or do they take it out? We'll have to see. And then look at 2024. The consensus was the Fed funds rate would fall to 4.6%. Does that change? Do the dots move down or up on that? Do they take out some of the cuts because maybe things are strong? And finally, let's do math. Kathy was talking about the GDP numbers. It's the inflation numbers you want to watch in their new summary of economic projections, because if they raise the inflation rates, then they're signaling they might have to do more. If they lower what they think is going to be the inflation rate for next year, especially, then they might have to do less. There probably isn't going to be a clear winner in this game, Matt, but it is some way to look at what the Fed is doing. A lot of short-term issues in front of them that they don't have the answer to. And so get back to my question that I told John Ferro I'd ask. How much confidence do you have in what you're forecasting today?
And what do you want to telegraph, Mike? Because I thought it was really interesting. Anna Wong, Bloomberg Economics chief U.S. economist, her base case is for the Fed to put a dot in there signifying another rate increase coming this year, but then not to do it. So essentially kind of jawboning, I guess, the effect of another rate increase until the end of the year, and we realized they didn't actually act on it.
Well, it's keeping their options open. The markets would react badly if they took the dot out and then had to come back and raise rates. That would be a surprise. If you leave the dot in and don't do it, that's not going to bother people too much.
All right, dots go is going to be a big focus today. Mike, thanks very much. I know you're there for the long haul throughout Fed Decides today. JP Morgan's chief Japan equity strategist sharing her outlook for a different central bank, and that may be more interesting. Globally, we're waiting for the BOJ. What does she say about their path ahead?
JP Morgan expects that BOJ policy step after YCC tweak in July. Next thing would be the YCC removal in early 2024. And then in mid-24, the removal of negative rates.
All right, so we have the BOE and the BOJ to follow. The BOJ, I think surveillance polled their guess, apparently was going to be the most interesting meeting. Now the BOE is also fascinating because of the little drop in inflation that they showed. But Kathy, what are you looking for in terms of yield curve control? Could this be a game changer?
Yeah, it certainly has the potential to have a pretty big impact. You know, we've been saying for years that the one thing that can change the outlook is if Japan eventually ends yield curve control. And it looks like it's coming. It's on its way. So that sets up a dynamic where you get perhaps less demand for U.S. Treasuries versus others. But keep in mind that, you know, the market is already starting to adjust to this, and much of the anticipation is probably already built into where JGBs are trading. So I think it's a short-term effect over the next 6 to 12 months, perhaps, but going out longer term, I don't think it really changes the dynamic of the, you know, the global market. So we had a bunch of central banks still tightening policy to try to slow inflation, and you have one central bank kind of edging in the other direction. I think the sum of that is, you know, it sort of equals itself out, but obviously a lot of volatility along the way.
All right, Troy, just want to quickly get how important other central banks are on your radar. I'm told that our economies are interconnected.
Yeah, I mean, I think when push comes to shove, you know, the Fed still has been and always will be the most powerful financial institution in the world. So, you know, it's not that every other central bank's a sideshow. To Kathy's point, they can have marginal impact. But imagine a scenario where yield curve control stayed and the Fed hiked by 50 more basis points. Like, what's going to dwarf the other? And so, you know, we obviously talked a bit about the risk to duration. But I think what is now an incredibly favorable scenario for investors in this environment is this concept of a dare to dream scenario, where if you're invested in floating rate debt, that's typically tied to speculative companies. In the case of commercial real estate, you know, you're senior secured in the capital structure. we're now in this environment where it's possible that rates stay elevated for years, not at 5.25%, 5.5%, but well above 3 or 4%. And we never have a give back of the income because defaults stay very, very benign as they have so far.
Right.
So, there's been some negative surprises in this cycle. Clearly, you think of how 60-40 did last year. You think about those that were over their skis in duration this year. But there's been a lot of upside surprises, and one is the continued strong performance of credit and the abundance of income at the front end of the curve.
Yep. All right. I think that's all we need to say about the BOE and the BOJ. We'll continue to focus on the Fed, but let's also look into the equity market. Kathy and Troy are going to stick with us on that, but Abigail Doolittle joins us for a look at stocks ahead of the opening bell. Abigail?
Well, Matt, we do, of course, have futures trading higher. Let's take a look at some of the idiosyncratic winners on the day. Coty shares are popping this after the company did boost their like-for-like sales growth along with adjusted full-year EBITDA guidance on strong beauty demand. Hudson Pacific Properties also higher. This is BMO upgrades to an outperform, saying that the West Coast REITs negative catalysts such as the Hollywood strike and a dividend suspension, well, they're priced in. And then finally, Pinterest popping 5.5%. A recent investor event has spurred some upgrades. Both Citi and D.A. Davidson, Matt, they've upgraded shares to a buy. Investors are taking notice.
Wow, an $18 billion stock Pinterest is. Abigail, thanks very much for that. Coming up, markets facing mounting headwinds out of Capitol Hill.
The UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown.
We'll discuss the state of play in Washington next. This is Bloomberg.
There's all these elements that we see kind of on the sidelines that we're waiting to see them flow through the economy. So obviously the UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown. It doesn't look like we're going to get an agreement anytime soon.
So markets facing mounting headwinds from Capitol Hill, the Biden administration holding off on a trip to Detroit as the UAW plans to expand strikes on Friday if no deal is reached. The White House writing, quote, given that negotiations are ongoing between the negotiating parties, it is most productive for Sperling and Sue to continue their discussions from Washington and allow talks to move forward, which doesn't sound very promising at all. This as House Republicans barrel towards a shutdown at the end of the month, with hardline conservatives foiling Speaker McCarthy's efforts to pass a short-term spending bill. Representative Ralph Norman saying, quote, we're going to have a shutdown. We believe in what we're doing. The jury will be the country. Bloomberg's David Welch joins us from Detroit with more on one of these kind of twin threats. David, the UAW strike doesn't seem like it's ending anytime soon.
It doesn't. Yesterday, UAW President Shawn Fain said that unless there's some real significant progress, which he didn't define, if that didn't happen by noon on Friday, then he would add plants to the three that he already has on strike. And I would assume they'd be pretty profitable plants, but we'll see who he picks. We'll find out Friday morning. But if he's threatening further action, then he's putting pressure on the companies, and that means there hasn't been enough progress at the bargaining table to get near a deal.
So what are we talking about in terms of, the amount of people who are going to be out of work here and the effect it's going to have on suppliers? Because worst case scenario, or one of the worst case scenarios, is that we get a part shortage and it affects all manufacturers, not just UAW plants.
That's right. And so you did see a strike of a parts plant in the South today that could have ripple effects. But what could happen out of the big UAW strike with the big three is if volumes are hurt enough at some of the plants that supply the big three, they might supply Toyota, Honda, Hyundai, Kia plants in the U.S. somewhere. And if it's no longer economical for them to run, or if they get shut down, then that could have a ripple effect. I don't think we're quite there yet because we only have 3 assembly plants in the U.S. that are down from the UAW strike. But if you add a lot more this weekend, you could see an effect coming out of that.
A lot of these, big three cars are produced Elsewhere in North America, Mexico, Canada. Canada has had their own union issues. What's the state of play there, David?
So the union delayed things by a day to see if they could come up with a deal. It's not quite as militant there as it is here, but it's also touch and go, and they're seeing pretty big offers from the UAW or for the UAW in the U.S., and they're going to want something pretty similar.
All right. David Welch there, Detroit Bureau Chief, wrapping up what we're facing in terms of the UAW. Kathy Jones and Troy Gajewski back with us to talk about how the government shutdown could affect things. Troy, what's your take on, well, really both of these threats?
Yeah, so I think if you look at the UAW in particular, I mean, it's part of a broader trend, right, where labor has far more power than at any time, not relative to the 50s and 60s when unions were much more dominant, but in terms of the average worker in such a tight labor market where there's so much labor hoarding. And on the one hand, obviously the strike puts a little bit of downward pressure on GDP growth. But on the other hand, if the union gets anywhere near the wage increases they're asking for, it just makes the Fed's job even tougher to constrain inflation, because ultimately, this is playing out as a mini version of the 70s, where you first have, inflation in goods and services, and then you spill over into the labor market, and you have an all-out wage spiral, which is obviously very problematic from an inflation standpoint.
Right.
In terms of the government shutdown, clearly that's a net negative for risk assets and growth in the short term. But I think the broader point there is if we were right now talking about these risks where equities were 14 times forward earnings, not as big of a deal. If the Fed was not doing QT, not as big of a deal. But we reflated back up to 19.5 times forward earnings, and you have all these issues simmering in the background. So you add a few negative catalysts on top of it, and it could lead to a more substantial risk-off period.
All right, I got to wrap it up there. But Kathy Jones of Charles Schwab and Troy Gajewski of FS Investments, really appreciate your insight this morning. Coming up next, the morning calls. And then later we'll speak to Michael Purvis of Talbacken to discuss the upcoming Fed rate decision. This is Bloomberg. This is the countdown to the open. I'm Matt Miller, in for Jonathan Ferro. First up, J.P. Morgan downgrading Dollar General to underweight, seeing a challenging outlook amid persistent inflation. And there's a story on the terminal that says it could be the worst place to work in America. Next up, Citigroup upgrading Pinterest to a buy. Abigail Doolittle talking about this, expecting user engagement to accelerate after its investor day. Pinterest is worth almost $18 billion, if you can believe it. And finally, Oppenheimer downgrading Chewy to a market perform, pointing to softening trends within the pet food category, but still not nearly as bad as Pets.com. Coming up, Talbacken's Michael Purvis. This is Bloomberg. This is the countdown to the open. I'm Matt Miller, in for Jonathan Ferro. Moments away from the start of trading, you have Klaviyo about to ring the opening bell at the New York Stock Exchange, with futures higher on the S&P up about 0.3%. Sigma Lithium ringing the bell over at the NASDAQ. There we go. Trading is started. Let's take a look at not just what futures show us, but some other asset classes here. The euro right now trading at 107.05 as we wait for the Fed decision, and then later the BOE and the BOJ. The 10-year yield at 432.87 right now, but it had hit the highest level since 2007, as had a lot of other tenors across the Treasury's curve. NYMEX crude coming back a little bit, down to $90.49 a barrel. Now, in terms of stocks, I mentioned Klaviyo as well as Sigma Lithium, but one to watch is the IPO from yesterday, Instacart, the grocery delivery company, fading after going public in one of the year's biggest listings. One Needham analyst writing, quote, "We see a balanced risk-reward reflecting slowing growth in the years following a pandemic-driven demand surge, and Carts," that's his ticker, C-A-R-T, Carts already scaled advertising business. Abigail Doolittle has more on Instacart. Abby?
So it seems as though we're now having a bit of a trend here, Matt, because Instacart is clearly not the only stock to have gone public over the last 2 weeks. We also had ARM, and both of these companies, these stocks, popping on the first day of trading. Now, relative to Instacart, yesterday it was up as much as 43%. It closed up 12%, not so shabby. Right now, down about 4%. So some of that speculative trading action that occurred yesterday, some of that excitement, it's dying down today. We saw that last week with ARM. ARM closed up 24% on its first trading day, and then the 3 subsequent days, not counting today, last time I looked, it was about flat, down 4 to 5%. So this is a lot different than some of the pandemic darling IPOs that we saw, such as Airbnb up 113%, Bumble up 64%, Affirm up 98%, Poshmark up 142%. This is positive, but when we put it into the perspective of when the IPO market was truly healthy, we still don't know. So, of course, as you were mentioning, later today, Klaviyo will be going public. Let's see how it does. Birkenstock is filed, and I would also make the argument that we still have the Fed out there. If they are in hiking mode, that makes these IPO, these growthier, more speculative investments, a little bit more risk is attached, plus inflation, oil on the rise. But everybody's hoping that this IPO window has opened up. Back in 2021, 976 companies went public. This year, it's basically a trickle. This is all about 2024. Is this going to grease the runway for next year for a strong IPO market? I think we're still in the discovery phase, Matt, especially as we have Instacart down 3%. Not so shabby, but it could be better.
Yeah, absolutely. Still undecided. We have a few months left to go, but I don't think that these IPOs represent, a huge window opening for the rest of the industry. Abigail Doolittle, thanks very much for that. Let's turn now to banking. Goldman Sachs in advanced talks to sell its Green Sky unit to a consortium that includes 6th Street Partners. The deal would also include KKR and PIMCO. Shonali Basak, our star Wall Street reporter, has more on this. So David Solomon unloading some of those assets.
Unloading some assets after already unloading some consumer assets. Really, this is a spate of good news for Goldman Sachs that has been trying to clean up its consumer business just weeks away from their earnings report in the middle of October. Now, as you've been saying, they are looking to sell the set of the Green Sky business, which they've already took a more than $500 million write-down to a group that includes 6th Street, KKR, and PIMCO. There's an irony here because remember, 6th Street as well has a lot of Goldman alumni on its own. It has Marty Chavez, the former CFO, Alan Waxman, and it is bringing on Julian Salisbury as well. So a homecoming of sorts. But remember, there is a price for everything. According to the Wall Street Journal, this deal may be around $500 million, a far cry from the $1.7 billion Green Sky was acquired for. But a lot of the cleanup work has been done, in addition to those Marcus loans being offloaded to the likes of Varde and Rhythm, as well as other assets tied to that consumer business. So perhaps David Solomon in mid-October can give investors a cleaner story on the consumer.
All right, we'll be watching it closely with you, Shonali Basak. Thanks very much for that. Let's turn to tech now. Intel getting mixed reviews for its innovation conference after providing a few, or just few, I should say, details about its manufacturing process. The CEO remaining focused on AI, saying, quote, AI represents a generational shift, giving rise to a new era of global expansion. Ed Ludlow joins us from the West Coast. You can tell because he's not wearing a tie and he's wearing shoes for tennis. Ed, what have you got?
Don't deceive the viewer. I'm sitting right next to you, Matt, here in New York City. You know that. Intel down 1.6% on a 2-day basis, on track for its biggest drop in a month, having fallen by the most since mid-June in yesterday's session. The AI story that Pat Gelsinger is trying to position with Intel is that the next wave will be on device. Remember, Intel, one of the principal makers of PC processors, and while right now we're focused on large language models with hundreds of billions parameters, those are built in data centers. The future for generative AI tools will be on local device PC powered by Intel processors. The manufacturing process you reference is for their foundry business, where Intel is hoping to shift to become more of a mainstay third-party contract manufacturer like TSMC is for much of the world's chip makers. And what we did not hear was a customer for 18A. That is their next generation node or manufacturing process. They are on track to start that process back into 2024, 2025. They've dangled there being a customer in the wings who Intel will make a chip for built on 18A. They've just never named them. And so they're making the right noises. They're talking about their own GPU for AI, which is called Gaudi 2, and how that is going to be competitive against NVIDIA and its H100s. But the ticket we're waiting for is to Intel Intel talking up its foundry business? When are they going to name that customer, and who are the customers thereafter? The stock down 1.8%.
All right. Fascinating stuff. Ed, thanks very much for that. He is sitting right next to me, but you can't tell because we do these shows down the barrel. There's no relationship shots. Turning to earnings, General Mills reaffirming its full-year forecast for 2024. The CEO saying, quote, "We delivered growth on top and bottom lines in the first quarter amid an evolving external environment." Simone Foxman here to tell us what exactly that means.
Yeah, that's right. We're seeing numbers that slightly topped analyst expectations, but not by much. The company reiterating its full-year sales forecast, looking for growth of 3 to 4%. That's higher than Wall Street analyst estimates of about 2.8%, seeing adjusted earnings per share come in at 109 to estimated 108. So slight beat there, but the problem is that a lot of this outperformance was driven by price increases, not necessarily growing volume. In fact, volume a little bit weaker than Wall Street had anticipated, -2% across its business lines. The CEO talking about moderating inflation, and in a statement said that he expects input inflation to rise 5 to 6% for the fiscal year. This is driven by labor costs. Really interesting considering what we have going on in Detroit. We got more on the consumer as well. Increased value-seeking behavior, especially in pet food. They don't expect a huge rebound nor a sharp decline there. We're seeing a little bit of weakness, even though we saw some gains early in the pre-market, but shares down over 22% this year, so maybe it can find a little bit of a bottom. Who knows?
All right, Simone, thanks very much. Simone Foxman there talking to us about GM, General Mills, not the car maker. Getting back to the story of the day, the Fed's rate decision coming up in just a few hours. Talbackin's Michael Purvis weighing in, writing, quote, "The Fed focuses on core inflation because crude and food prices are volatile." I'm glad he didn't use the word transitory. But perhaps they need to be a more important part of the rate policy discussion. Michael Purvis joins us in person now. Michael, great to get you on the program. So why would they want to focus on food and oil prices? Is it because it's one of the only things all of us actually needs to survive?
Well, certainly there's obviously a political dimension to food and oil price inflation here. But, you know, if you go back to 1970 and you look at rises in crude oil, more than 2/3 of the time that if the rise is more than 20%, core inflation increases, and sometimes by a very material way, as much as 1.5% in the coming months. It tends to lead, increases in core inflation. Now, if the move is small, say 10%, there's no real statistical evidence, to demonstrate that. But what we're seeing here, since June, crude prices are up 30%. Volatility of crude, which I think is a really interesting feature of this whole crude rally, has actually gone down. And there's an echo in this in interest rates, where rates have been going up, of course, but the rate volatility has been going down. In fact, just last week, we had a new high in the 10-year yield for this cycle and a new low in the MOVE index for this cycle there. And I think those are speaking to the fact that, after so much shock and awe between COVID and 2020 and then the Ukraine war early in 2022, we're sort of post-shock, but we're into these new, the world's contending with these new structural themes that are developing here. And those are moving slower, but they're in some ways arguably more significant. And so I think what we have to, realize is that crude oil is going to help ultimately push up several facets of core inflation there. And then, of course, there's the wage discussion and there's housing discussion and all that. But it is a really important part of the broader economy. And it is lower volatility today as well. So maybe the Fed should kind of blend core and headline inflation more together in their thinking here. This is not about an oil shock. These are about structural shifts with decent demand and tighter supply, keeping oil at the prices where it is. And I think there's a good chance that oil will stay where it is. And if that's the case, next winter, we're probably going to see core considerably tighter, barring some massive external shocks.
I was going to say, unless, there's a recession, and because this oil price, $90 WTI, as I understand it, it's not driven by demand growth, right? So if we have a recession, if people, I wouldn't want this to happen, but lose their jobs and no longer drive to work, or, if they go back to WFH, isn't that going to help bring down the price of oil as well?
Sure, yeah, certainly there. But of course, right now, it's hard to call for a recession. I think Bloomberg's economist actually is saying that next winter. But
Our
see a high
model only
chance of
showed a
recession.
100% chance, Michael, of a recession in this half.
But I would say still, I'm not on that page. I think there's a lot of very strong factors keeping the the economy in reasonably decent shape. Not great shape, but decent shape. Right.
But what? I mean, the consumer's out of money.
Not yet. They're not.
The school bills are going to become due again. More and more purchases are put on plastic. The payments there are seeing a lot more delinquencies. Auto loan delinquencies are just going up and to the right. Oil is expensive. There'll be a government shutdown. We've got a UAW strike. I mean, I could go on and on and on. Why do you think this economy is firing on all cylinders?
Well, look at the employment statistics, right? They're still, sort of defying the notion that interest rates were going to crush employment, and they haven't. So, look, Matt, everything you just mentioned, that laundry list of economic bear concerns, are all real concerns. But there's also a list of things that are just, there's a lot of important new structural themes that are helping to keep the economy going. But I agree, we're going to see a bit of a downshift here. I just don't think it's going to be something that's going to be that, that big crash landing that so many people anticipated to happen early in this year. I look at it as more of a meh year next year, where a slight degradation in growth and inflation, but still I think we're walking into a higher nominal world here. There. And don't forget, Matt, oil prices are higher, but, today the United States is a large oil producer, right? We're there. And what's bad for us at the pump is also good for so much of the Texas economy as well. So it's a very nuanced story here as it relates to the United States.
As they all are. Michael, great to get some time with you. Come into the office next time. Michael Purvis there. He's going to stick with us. Coming up, the IPO frenzy continues.
The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That conversation up next. This is Bloomberg.
The issue is more around what is the appetite among investors for IPOs, and to what extent are people looking to deploy risk capital into some of these earlier stage names. The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That was Morgan Stanley's Lisa Shallett weighing in on the IPO market. Klaviyo, apparently it's Klaviyo, making its trading debut today, pricing its IPO above the marketed range to raise $576 million in the third major U.S. listing of the week. This on the heels of SoftBank's chip designer ARM Holdings and Instacart. We were talking about that rally kind of fizzling out the day of and the day after its IPO. Let's bring in Bloomberg's Shonali Basak for more for more of a look, I guess, at this IPO climate. Shonali?
Yeah, when you look at Klaviyo's IPO, for example, you do have not only them hitting above the top end of the range, you have Klaviyo going into a green market. The S&P today up on the day. When Instacart listed yesterday, they did not have the same market heat, although volatility has been low enough to make these listings smooth in a year where IPOs have come to a pretty screeching halt. This is bringing fervor back into the market. Klaviyo has also something that Instacart didn't have as drastically, which is a tie-in to the AI industry more directly. They have come in with cornerstone investors to the likes of AllianceBernstein, BlackRock, and Shopify was an early investor as well here. Interestingly, Matt, you have also had a lot of retail interest in these IPOs. And when you look at Klaviyo today, another interesting aspect of this, Matt, is it's going to price and also list its first trade likely within hours of that Fed decision. So you do have these companies trying to make it to market before any potential volatility were to hit the market and impact risk appetite from investors. Now, we've been talking about this a lot on this program. One day does not make a trend. How these IPOs keep trading will make a big difference, more than there is for Instacart. There are not a lot of grocery delivery companies in the pipeline for future IPOs, but there are a lot of SaaS companies in the pipeline, as Axios points out this morning. And so Klaviyo's listing today, any potential success of it, means a lot for those companies in the pipeline, as well as underwriters. This is a trifecta for Goldman Sachs. And today we also have Morgan Stanley and Citigroup on the listing, as they were not as prominently listed yesterday and last week.
Shonali, thanks very much. Shonali Basak there talking to us about IPOs. Michael Purvis from Talbacken weighing in on the IPO market, saying, quote, after a brutal 2022, the IPO market is coming back to life. The VIX has averaged less than 15 since June. This, combined with strong equity performance, has set the table for an IPO renaissance. Michael Purvis still with us. So what do you think of the action that we've seen this week? Is it going to lure more companies back to public markets?
Look, if the IPO market, if the aftermarket performance here does reasonably well, doesn't have to be great, but as long as it does reasonably well, doesn't fall apart, the market doesn't fall apart, and the VIX stays low, then yeah, I think the table's set. I mean, don't forget, Matt, that VCs need exits and bankers, investment banks need fees, right? And there's, I call it sort of like the VC banker industrial complex, if you will. So when the macro conditions, get, pale green light, as they just have been over the last 4 weeks, that's going to set the table for more and more companies, to go public, because there's a lot of people, whether it's the management, the VCs, private equity, or the bankers who are all incentivized, to do that. And it's a very healthy part of the, broader, economic system that we live in, to have this capital.
Well, what are the risks?
Capital come in and recycled.
Michael, I mean, as Shonali was saying it, I just realized, oh yeah, the Fed on the same day as an IPO, is that risky? They have to start trading before 2, I guess, which these days isn't exactly a sure thing. And you've got the bigger looming risks of a government shutdown that's almost guaranteed to happen, and a UAW strike that looks like it's going to stretch out. So could that, ruin the party?
Well, let me take those one at a time. Look, in terms of the Fed Day issue, look, if we were having this conversation a year ago, absolutely, that would be a big issue. But if you actually look at, broader equity market performance on Fed days or CPI days over the last several months, it's not a big thing. It really is not there. So I think that, the broader complexion is, are there still, people that want to allocate into this market? And it seems like there are here. And people, IPOs always engender excitement there. Regarding the government shutdown, that, again, is always one of these like sort of perma risk. Unfortunately, it seems to be one of these perma topics that the markets have to contend with, and the markets generally, by and large, tend to work through those. With respect to the UAW, yes, that's another, big risk. I'd argue that it's a bit more political than economic or markets right now, although it does, speak to this issue we were talking about in the earlier segment on higher labor cost, slowly, and steadily, coming into, the broader economic condition of inflation there. So, yeah, the bankers are going to say, look, things are pretty good. We're, September, the market's supposed to be volatile. It's only down 1.5% month to date.
But it looks okay
here.
But it looks okay so far. Michael, I got to wrap you up there. Unfortunately, Michael Purvis from Talbacken, appreciate you joining us, talking about the IPO market. We are going to talk when we come back about the market-moving events you need to be watching. We're going to give you your trading diary next. This is Bloomberg. This is Bloomberg's The Open. I'm Matt Miller in for John Ferro. Time now for the Trading Diary, what you need to be watching this week. We get, you may have heard, a Fed rate decision at 2 p.m. Eastern. Chair Powell's news conference coming at 2:30 p.m. The BOE announces its own rate decision tomorrow. Plus, we'll get U.S. jobless claims and existing home sales on Thursday. Finally, on Friday, a BOJ rate decision that I'm told is going to be fascinating. A special programming note, make sure to tune in for Bloomberg's The Fed Decides. John Ferro, Tom Keene, Lisa Abramowitz count us down to the latest rate decision and Chair Powell's news conference. That coverage kicks off at 1:30 Eastern Time. This was the countdown to the open. This is Bloomberg.